the fixed income market is so broad. You have floating, you have fixed, you have converts, you have straight bonds, you have sinking fund bonds, you have mortgage prepayment bonds. The fixed income market is so broad. I don't think there's a one strategy fits all. Um, Look, at the end of the day, I think we are in a very, very heightened period of high valuations for equities. We are in high valuations for real estate. I mean, homeowners, home prices are definitely over the top. We are in tight spreads, meaning the amount you get paid over a US Treasury for its equivalent maturity in investment grade and high yield are quite tight, meaning you're not getting paid a lot.
The fixed income market is massive and complex. We're not just talking about one thing here. You've got floating rate, fixed rate, convertibles, straight bonds, sinking fund bonds, mortgage prepayment bonds. The list goes on. This isn't a one-size-fits-all market, and there's no single strategy that solves for all of it. Either way, if you're finding this breakdown helpful, make sure to like the video and subscribe to the channel. I'm breaking down this kind of institutional level insight every day. Now zoom out. Equities, valuations are stretched, real estate, home prices are off the charts, spreads incredibly tight. That means the premium you're getting paid over treasuries, whether it's investment grade or high yield, is thin. Translation, you're taking on risk and not getting paid enough for it. That's the environment we're in, and if you're not thinking critically about risk-adjusted return, you're playing the wrong game. Let's go back to the interview.
Can you just explain from an economic theory perspective why it is that the bond market, at least the yield curve, has been pretty accurate in predicting recessions based on this pattern?
Actually, it hasn't been that accurate. I think there's
Okay.
a view that the 210 has been a very, very accurate indicator. Um, I think that the facts might meet the test, but there's been plenty of periods where you have elevated 2 to 10 where you've had
Mhm.
no recession, right? You can look on your own graph and see easily plenty of sustained periods where you have the 210 issue where there was no recession. Even the SOM index, SOHM, which has been a much better predictor of recessions. And the author of this has said, it's not as reliable as one thinks. Everyone's looking for the golden chalice or the solution to age. And to me, these are great technical tools to help frame a discussion, but they're not the end all and be all.
But can you just explain why? Okay, so yes, you're right. I mean, not every single reinversion has led to a recession, but let's just take the ones that have, for example. Why is it that the long end of the curve tends to steepen right at the onset of a contraction?
I think,
I just don't think of it that way. So,
okay.
I mean, I understand what you're saying. Um, and by the way, it's not really the long end that's steepening in this case. That it's
It could
right.
be it
You're
could be the
doing
2 year falling. Yeah.
no, but the concept is you have an inverted yield curve, correct?
Right.
Right. So the question is, why do you have an inverted yield curve, right? And you have an inverted yield curve, right, for many different reasons. And I think this is a very good tool to think about what's going in the economy. But the 2008 10 period yield curve inversion was extremely different than the sort of uh 90. I mean, I think, I would say the 92 period, right? So I appreciate where you're headed. Again, I'm not a macro uh, top down or macro forecaster or macro strategist. I'm a bottom up investor that uses the tools of macro to make
Hmm.
money. In our career, we think the way to do this is, the way you make money is you protect capital first and foremost, and then you make selective, smart decisions, knowing you're going to make mistakes. But I think people spend a lot of time of, oh, is the Fed going to raise rates? Are they going to lower rates? Or what happens if it moves a quarter point? Truthfully, if interest rates stayed where they are today, the Fed fund
Hmm.
rate stayed here today. They don't move, they don't go down. Is it really contracting the economy? And if they drop rates 100 basis points, are you really making an economy healthier, or are you just increasing asset values and speculation? In other words, I'm not sure Fed fund rates are at a price today that they're choking off capital investment and they're choking off the economy. I think rates can be a little bit like a drug, right? You can bring them down so low to stimulate the economy, but we know negative rates, which had Europe happen, didn't stimulate the economy for a long time. I think there are a period where rates are really a problem.
Okay.
And I think where on the curve is a problem.
Well, let's
right?
talk about your funds.
And by the way, what
Yeah.
this is really about is the conflict between employment, dollar stabilization, and inflation. And I assure you, if the Fed or the government gets its way and they lower rates, and I think they're going to lower rates. I think rates are definitely coming lower, and I think it will definitely ease the depth of a slowdown. Okay. But let's be clear. It also, you have to think about all the other factors. So what's likely to happen is dollar devaluation. That's what's likely to happen. And you can spend all the time you want about whether rates should go up or higher. I'm convinced the dollar is going to continue to devalue. And that's really the bigger picture. And I think the other bigger picture is, are we going to have a Fed that's going to be able to remain independent? Those are really two big macro pictures that I think have a much more important long-term effect than whether the Fed drops rates 100 basis points over the next 12 months.
So why has a yield curve, especially the 2 South and TANs, become such a widely watched recession signal? Well, historically, when short-term yields rise above long-term yields, it's often a sign that investors expect growth and inflation to slow. That's what we call an inverted yield curve. And yes, inversions have preceded many recessions, but that doesn't mean every inversion causes one. Far from it. In fact, there are plenty of periods where the yield curve stayed inverted, and no recession followed. Even a SAM rule, which is arguably a better recession signal, isn't flawless. No indicator is, because let's be honest, everyone's looking for the magic formula, the golden chalice that predicts the future, but macro doesn't work like that. These tools are just frameworks. They help us understand risk. They're not the final answer. And the real question isn't just why the curve is inverted. It's what does it actually mean for capital allocation *C. Some people obsess over whether the Fed hikes another 25 basis points or cuts 100, but that's not really the point. If the Fed held rates right where they are, would that alone contract the economy? And if they slash them by 100 basis points, does that really create growth or just inflate asset prices? We've already seen that ultra-low or even negative rates in Europe didn't spark real economic activity. In fact, rates can act like a drug. Over time, the effects wear off. What's really at stake here are two big macro forces. Dollar devaluation, lower rates may ease a slowdown, but they weaken the dollar. Federal Reserve independence. If policy becomes politically driven, market confidence changes. So yeah, watch the curve, pay attention to rates, but don't get hypnotized by one metric. The bigger story is about currency, capital flow, and long-term positioning. Let's go back to the video.
The current policies. Right now, you have President Trump, who believes the Fed is behind the curve, and they probably are. I mean, I'm not arguing that he's wrong. They probably are behind the curve. You can just look at the reduction of forces and the unemployment. You know, the Fed's in a tough spot because if they reduce things too much, you could get some serious inflation. And with the tariff and the American First policy, they're balancing that. Plus, they're balancing both Republicans and Democrats that are equally aligned in spending money. They may spend it differently, but none of them seem to have any desire not to spend money, right? And then you have a huge wall of financing that the Treasury has to refinance, and a country that continues to need more and more money to fund its businesses, and we're getting less and less externally financed, right? If all of your deficits are externally financed, that's a good problem, not a bad problem if you're the world currency reserve, right? But when you're the world currency reserve and you gradually internalize all that debt, not as good. And this has been going on for a long time. I mean, I remember in 2002 writing our hedge fund letter saying there was a billboard in LA and it said, "Keep shopping, your economy needs you," right? So this relying on the consumer has been a big thrust in America. Now there's a policy to change that. But why is the Fed independence a concern? Because if the Fed isn't independent, it's breaking down checks and balances. And there has been some discussion about when Fed Powell's term is up in May, who's going to replace him, and is it more of an independent party, or is it more a political appointee? And there's also been discussions of would the executive branch, because they want to see rates lower immediately, and they want to see the ability to refinance our debt at a lower rates immediately in replacing Chairman Powell. I don't think they're going to, but there have been discussions about that. So, I think independence is a really good, healthy thing for the Fed. And I also think that we're going to get lower rates, but with lower rates, we're going to get a decline in the dollar, which ultimately has inflationary effects if you buy things overseas or you want to travel overseas.
Right now, you've got President Trump saying the Fed is behind the curve, and honestly, he might be right. Just look at unemployment and labor force reductions. The Fed's in a tough spot. If they tighten too much, they risk serious inflation, especially with tariffs and the America First policy in play. At the same time, both Republicans and Democrats are in full agreement on one thing: spend more money. They may spend it differently, but the spending never stops. Meanwhile, the Treasury has a wall of debt to refinance, and we're relying less and less on foreign capital. That's not great. See, when you're the world reserve currency and your deficits are externally financed, that's a manageable problem. But when you internalize that debt and you're printing to fund yourself, now you're eroding the foundation. This isn't new. Back in 2002, there were billboards in LA saying, "Keep shopping, your economy needs you." That consumer-driven model is still alive. But now we're trying to pivot ***. Now, here's the bigger concern: Fed independence. If the Fed becomes politically captured, we lose the checks and balances that protect monetary policy. There's already talk about what happens when Powell's term ends. Will he be replaced with someone independent, or a political appointee who'll cut rates just to make refinancing easier? I don't think he's getting replaced, but the fact that it's even a conversation tells you everything. Yes, rates are likely coming down, but that also means the dollar weakens, and when that happens, imported inflation rises. Travel gets more expensive. Goods cost more. So yeah, we'll get lower rates, but the price we pay might be a lot more than just cheaper debt. If you want to understand what happens next as the Fed cuts rates and the dollar keeps weakening, watch the next video. It all connects.